Most investors spend their energy measuring how much they lose, the drawdown depth as a percentage decline from a peak. But the true killer of quantitative strategies is not the size of that percentage, it is the length of time spent underwater. Investors fixate on drawdown depth, the percentage drop from a peak, because it is a single, easily visible number that feels urgent. They ask, how much can I lose, and design risk limits around that figure. But this focus on magnitude misses a subtler, more destructive force, time. A 20% drawdown that lasts a month is little more than a brief scare, the market recovers before doubt can take root. The same 20% drawdown that lasts 3 years becomes a psychological war of attrition. Over that span, the investor not only sees the capital lower, but also experiences the compounding erosion of confidence, patience, and trust in the strategy's logic. The market doesn't just take your money, it takes your patience, and patience is the scarce resource that quantitative strategies rely on. Therefore, assessing risk solely by depth ignores the temporal dimension that determines whether an investor can stay the course. Let's formalize the problem with precise definitions. A drawdown is the peak-to-trough decline in a strategy's value, measuring how much value was lost from the highest point before a new high is reached. Duration, however, is the time spent below the previous peak until a new high is made. This measure captures the psychological and capital cost of waiting, because every month below the peak represents a period when capital is not compounding at the strategy's expected rate and the investor is bearing the stress of uncertainty. The longer the duration, the more likely an investor abandons the strategy before recovery, thereby locking in the loss. Mathematically, if two strategies have identical drawdown depths but one recovers in 6 months and the other takes 3 years, the second imposes a higher total cost on both wealth and decision-making. Thus, duration is an essential, often neglected risk metric. Human brains are wired to process losses more intensely than gains, a bias known as loss aversion. The pain of losing $1 is typically felt more strongly than the pleasure of gaining $1. But the brain also struggles with uncertainty over long horizons. A 3-year drawdown feels like the strategy is broken, even if the underlying logic remains sound, because each passing month without recovery adds cognitive dissonance and erodes conviction. The pain is not linear, it compounds with each additional period of underperformance. Eventually, the investor capitulates, selling near the bottom to escape the psychological discomfort, and the paper loss becomes a real, permanent loss. This is why duration matters more than depth. A deep but brief drawdown may trigger fear, but a moderate but prolonged drawdown triggers despair, and despair is far more likely to cause abandonment. There is an opportunity cost to being stuck in a drawdown. The formula for future value, where terminal wealth equals the initial capital multiplied by the growth factor over time, shows how a prolonged drawdown reduces terminal wealth relative to what could have been earned elsewhere. If you could have invested in a different strategy or asset, the gap between the actual path and the alternative path widens with each period of underperformance. This is the hidden tax of duration. It's not just what you lose in the drawdown itself, but what you could have earned during that time had your capital been deployed productively. The longer the wait, the larger the foregone compounding, and the harder it becomes to catch up. Therefore, a strategy's duration risk directly attacks the investor's long-term wealth accumulation, even if the eventual recovery arrives. Consider 2 scenarios to illustrate the difference. In the first, a strategy suffers a 30% drawdown that recovers in 6 months. The investor is shaken but stays because the loss is large but brief, and the quick recovery validates the decision to hold. In the second scenario, a strategy suffers a 15% drawdown that lasts 3 years. The investor watches their capital stagnate month after month, begins to question the strategy's soundness, and likely exits before any recovery occurs. The second scenario is more dangerous, even though the percentage loss is smaller, because the extended duration exhausts the investor's patience and forces a behavioral mistake. This comparison shows that risk is not solely about magnitude, it is about how long pain must be endured. Duration is the silent killer that turns a manageable loss into a permanent one. We can model the probability of investor exit using a simple threshold framework. Let E be the probability of exit, T be the time in drawdown, and L be the loss aversion coefficient. The longer the drawdown, the higher the exit probability, approaching certainty as T stretches beyond the investor's tolerance. The loss aversion coefficient L scales the sensitivity to each additional period, a more loss-averse investor will reach the exit threshold earlier. This is a stylized model, but it captures the essence. Time is the enemy because it compounds the psychological burden. Even if the expected return of the strategy has not changed, the probability of an investor abandoning the strategy increases with each month below the prior peak. Therefore, strategy designers must account for exit risk as a function of duration, not just depth. Why do even good strategies experience prolonged underperformance? Markets are cyclical and irrational, and a strategy can be correct in the long run while suffering for years. Value strategies, for example, can lag growth for years because investor sentiment or macroeconomic conditions temporarily favor expensive stocks. Momentum can reverse violently when market regimes shift, causing sharp drawdowns that take time to recover. These are not model failures, they are features of market dynamics that no strategy can avoid entirely. If a strategy has historically had a 3-year drawdown, you should expect it again, because the underlying cyclical forces will repeat in some form. The logic may be sound, but the market's timing is unpredictable, and that unpredictability creates duration risk. Investors who do not prepare for long periods of underperformance will be forced out by their own impatience. This leads to a core portfolio design principle. If your strategy has historically endured long low-return periods, you must expect them in the future and design for patience. That means setting realistic investor expectations up front so that a 3-year drawdown is not a surprise but an anticipated scenario. It means aligning capital with the strategy's natural horizon, using only funds that can be locked up for the required period without forced redemptions. It also means building in mechanisms to withstand the psychological pressure, such as clear reporting on drawdown duration, disciplined rebalancing, and possibly lower leverage to avoid amplifications of pain. The strategy must survive its own drawdowns. A mathematically sound strategy that cannot retain its investors during a prolonged underwater period is worthless in practice, because the investors will leave before the recovery arrives. Let's look at illustrative examples from major markets. The S&P 500 experienced a 51% drawdown from 2007 to 2009, but it recovered in about 4 years. Japan's Nikkei 225, however, peaked in 1989 and did not regain that level for over 30 years. The duration, not the depth, made Japan's case so damaging for investors. Although the S&P 500's drawdown was deeper in percentage terms, its relatively quick recovery allowed investors to recoup losses and continue compounding. In contrast, the Nikkei's multi-decade stagnation meant that an entire generation of investors saw no net gains, and many capitulated long before the eventual recovery. The Japanese example shows that even without a catastrophic single-year loss, a strategy or market that stays underwater for decades destroys more wealth through opportunity cost and psychological exhaustion than a sharp but short crash. So the real risk is not whether the strategy will lose money, it's whether you and your investors can maintain trust during the loss. Trust is the scarcest capital. A strategy that cannot survive its own drawdowns is not a strategy, it's a gamble on patience, because the mathematical edge may exist but the human element will determine whether the capital remains to capture it. The math may work, but the human element is the ultimate constraint. When a drawdown drags on, investors ask not, is this within expected variance, but is this manager broken? That question, repeated month after month, erodes the trust that is necessary for long-term commitment. Therefore, risk management must include managing the duration of pain and the communication around it, because once trust is lost, no amount of future returns can recover the capital that has already exited. In the end, drawdown duration is the silent killer of quantitative strategies. It doesn't announce itself with a crash, it erodes confidence month by month, slowly converting rational investors into reluctant sellers. The most robust strategies are not those that never lose, since all strategies lose at some point, but those that can survive the long waits between new highs. When you design a strategy, ask not only, how much can it lose, but, how long can it stay down? And ask yourself, can you and your investors endure that time? If not, the strategy will fail, not because the math is wrong, but because human patience runs out. This is DeepQuant. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.